mean variance portfolio choice rules. Okay, now this one, so this is section 2.7. There are a couple of rules that you need to know. One, you already know, that's this one. But I'll stop making assumptions about what I think you know. So we will just go through this, and then on the next slide will be something new and interesting and different. Okay, so portfolio A is better than B if the mean return on A, so you have portfolio A and B. So if the return of A is equal to or larger than B, but A has a smaller standard deviation than B. Okay, so clearly if RA is greater than or equal to return on B, and the standard deviation of the returns on A are less than the standard deviation of the returns on B, then A dominates B. A is better than B. Another way of saying the same thing is, if the mean return on A is strictly larger than on B, but A and B have the same standard deviation of return, then again A is better. Okay, you knew this, right? Okay. Here is something else that you knew. If portfolio P, so if you have portfolio P where the Sharpe ratio is greater than the Sharpe ratio of portfolio Q, then what's better? P is better. Now speaking of Sharpe ratio, what is it? Okay, so it's the excess return per unit of risk. So it's the return on the portfolio minus the risk-free rate divided by standard deviation of the portfolio. Now this is a ratio that keeps coming across all levels in different subjects, starting from level 1 quant all the way to level 3. It's a ratio that keeps coming over and over. Okay, now here is the new and different item. Now that you are further along in your journey of becoming professional investment managers, the question is this. Let's say that you are managing a portfolio. Okay, so this is your portfolio, and currently this portfolio has a expected return denoted by ERP. This portfolio has a standard deviation given by the usual symbol, and you have a new asset. So there is some new asset, and you are wondering whether to add this new asset to the portfolio. So the question is, how do you make that decision to add or not to add? And the answer is this. Let's understand the formula, and then the logic should also make sense. What you do is, you look at the expected return of your new asset. Okay, let's say that the new asset is General Electric stock. So you look at the expected return on General Electric minus the risk-free rate divided by this. So what is this? This is the Sharpe ratio of your new asset that you are considering. Okay, you are considering whether to add this to the portfolio. If this number, the Sharpe ratio, is greater than the Sharpe ratio of your existing portfolio multiplied by the correlation between the new asset and the portfolio, then you add. If it is less, then do not add. And how can you remember this? Imagine that the correlation is 1. If the correlation is 1, then clearly if the Sharpe ratio of the new asset is more than the Sharpe ratio of the existing portfolio, it makes sense to add. What if the correlation is low? It's, let's say, 0.3. If the correlation between two assets is 0.3, then even if the Sharpe ratio is slightly lower for the new asset, then given the diversification benefit, it would still make sense to add. And how does that happen? That happens because the Sharpe ratio of the new asset simply needs to exceed the product of Sharpe ratio of your portfolio multiplied by the correlation. So notice that if an asset has low correlation with the portfolio, then it is generally easier to justify adding it to the portfolio. Can you remember this? So just add asset if Sharpe ratio of asset greater than Sharpe ratio of portfolio times correlation. And it will be, I just said correlation. Why? Because there's obviously only one relevant correlation. Okay, so remember that and do this. This time I'm not giving you the formula, but you need to know it. So what do you do here? What do you compare? What is the Sharpe ratio of the new asset? So for the Sharpe ratio of the new asset is 0.10. You compare this with what? You compare this with the Sharpe ratio of your existing portfolio, which is 0.25 multiplied by what? Multiplied by this correlation. So is this greater than or less than? You do the math and this is less than, so do not add. Okay. What about the next guy? So here you add. Why? Because if you look at the Sharpe ratio, so let's look at this guy. Predicted Sharpe ratio is 0.3 and the predicted correlation is this. So you look at 0.25 multiplied by 0.67 and this is greater. Okay, so you add. And can you imagine that the CFA Institute likes these sorts of questions? It's actually I think it's one of their favorites, and it is such a practical concept. You are a portfolio manager and you have to decide what to add, what not to add. So this is conceptual as well as a little bit of number crunching, so it's a good candidate. Let's continue now with section 3 of the curriculum, practical issues in mean variance analysis. So far we've been in a nice theoretical world where we assume returns, we assume variances, and we create these nice portfolios, we create nice lines, we make assumptions, and then work in this wonderful theoretical world. But what we are going to do now is look at some practical issues that should concern us. And we need to be aware of the following. We now discuss the practical issues that arise in the application of mean variance analysis in choosing portfolios. The two areas of focus are, number one, estimating inputs for mean variance optimization, and two, the instability of the mean variance frontier, which results from the optimization process's sensitivity to inputs. So up till now we have assumed that we know expected returns and we know variance and we know correlations and we just plug them in. But let's now talk about the practical issues in estimating these inputs. Okay, so now the first set of practical issues, which is estimating the inputs. That's section 3.1, estimating inputs for mean variance analysis. The way you can think of this is as follows. So there are three ways in which you can estimate the inputs. And just off the top of your head, what are those inputs that you need for mean variance analysis? You need expected returns, which are the means, the variances of all your assets, and all the pairwise correlation. So those are the three things you need. So obviously, one way of coming up with those estimates is to look at the past. If you want your mean return for large cap stocks, what's the first thing to do? You look at historical returns. Okay, all that data is there. So pick that up. What about variances? Once you have your historical returns, you can calculate variances. Can you calculate correlations based on historical data? You sure can. Just plug the numbers into some statistical program and give it the time period. It will give you the correlation. So can you do that? Of course you can. Okay, that's one method. There are two other methods that we will talk about on subsequent slides. So let's just, with these items, there aren't that many, as in there aren't any number crunching problems to do. From an exam perspective, as long as you know this big picture, that there are three ways of estimating, and then for each method you know this paragraph that's taken out of the summary, you are in good shape. So what are the issues with using historical estimates? To trace out the minimum variance frontier with n assets, we will need n expected returns, n variances, and n multiplied by n minus 1 divided by 2 covariances. So what's the point here? Do you understand what this means? This means that in your portfolio, if you have 30 assets, how many inputs do you need to estimate? You need to estimate 30 plus 30 plus how many pairwise correlations will you have? You actually have quite a few. You have n, which is 30, multiplied by 29, divided by 2. So this is a squared term, and the point is that n, as n goes up, the number of inputs that you need to estimate goes up a lot. Okay, will that make life difficult? It certainly will. Okay, so if we use historical values as inputs of mean variance optimization, then for realistic values of n, the number of parameters that need to be estimated is very large, owing mostly to the number of covariances needed. So this term over here. Historical estimates are also critically subject to estimation error. So two core points when we use historical estimates. One is the number of items that we need to estimate. And secondly, that typically when you use historical data, what you do is you take samples from large amounts of data, and as you've studied in level 1 quant, when you take samples, then clearly there will be sampling errors and so on. We don't need to go into the mechanics or the numbers. All we need to know is that with historical estimates, these are the two issues: the number of inputs and the possible errors because of the process of selecting your data. Good enough? So we've covered the first one. So under the heading of estimating inputs, we've done the first. The second method of estimating your inputs is to use market model estimates. Actually, I just want to highlight one other point, just make it explicit. When we have n assets, how many pairwise correlations or covariances do we have? So do you remember this from level 1, n into n minus 1 over 2? That's given over here, but I just want you to know that. Okay, n into n minus 1 over 2. Does everybody understand what this means? So when n is 3, how many pairwise correlations did we have? 3 into 2 divided by 2, which was 3. When n is 2, then this is simply 1. Okay, coming back to this. So this now is the second approach for coming up with what? With your various estimates of your inputs. And in your learning objectives, the expectation is that you know what market model is. Okay, and here we use what's called the historical beta or the unadjusted beta. So all you need to do, I think, is memorize the content on this slide, which comes mostly from the summary in the curriculum. The market model explains the return on a risky asset as a linear regression with the return on the market as the independent variable. So your return on the market is the independent variable. Your return on a given asset I is the explains the return as a linear regression with the return on the market as the independent variable. So normally your independent variable is on the x-axis, and this is the return on a given stock. Okay, so you run this regression, get your various scatter plot and come up with the best fit. Now we don't need to go into the derivation, but all we need to remember then is this. Based on the market model, the variance of asset I is given by the beta of I, so the beta of that asset squared multiplied by, what's this? The variance of the market returns plus the variance of a error term. Okay, so in the market model we also have to put in this error term. Okay, this you might recall from earlier that the variance of a given asset is the beta squared multiplied by the variance of the market. So it's the same thing here with the error term. And what is the covariance of two assets I and j? It is beta I multiplied by beta j multiplied by the variance of the market. So just you have to learn these. Put these on your formula sheet and learn this. Where do the betas come from? They come from the regression. We can use the expression for covariance from the market model to greatly simplify the calculation task of estimating the covariances needed to trace out the minimum variance frontier. So the big advantage of this method over what we talked about on the previous slide is the calculation is simplified. Using the parameters of the market model, we can express the correlation between returns on two assets like this. Okay, so if we have all the betas, we can come up with returns plus we can come up with the correlation. Is correlation between assets needed in a mean variance model? It is. Okay, it is needed. So this is the formula for the correlation. Now this might look ugly, but it is not as bad as it looks. Here is how you remember this. You need to remember this formula, and the way to remember this is to just remember that you want to, hopefully this should look somewhat familiar from before, except that with the market model you also worry about the error term. Do you remember that the correlation between two assets is equal to beta 1 beta 2 times the variance of the market divided by what? Divided by the standard deviation of 1 multiplied by the standard deviation of 2. Now if you remember this formula, great. If you don't remember it, then learn it now. And look at the relationship between these two formulas at the bottom. The numerator over here and here are the same. Okay, so these two, the numerators are the same. Look at the denominator. What is the standard deviation of 1? The standard deviation of 1 is simply coming from here. So what's the standard deviation for asset I? It is the square root. So the square root of that is the square root of this number. Okay, so which is simply given over here. This thing to the power of half. And this is simply the same expression for asset 2. Okay, so pause this for a few minutes and make sure that you remember this. Okay, the third method is to use adjusted beta, and hopefully this should ring a bell. You saw this in equity. Now betas revert to 1. Okay, so if an asset has a high beta, then what will happen? Over time it will revert to 1. If an asset has a low beta, then over time it will move up to 1. And hopefully you recall this formula for adjusted beta. These numbers just need to be remembered. So an adjusted beta is always 0.33, or at least in our world, it's 0.33 plus 0.67 times the historical beta. And these are 3 simple examples from the curriculum, which are really simple. So just go through this once and it should be easy. All right. Remember, when we talked about practical issues, there were 2 high-level categories. The first one was issues in estimating, and then the second is this, instability in the minimum variance frontier. So I think the best explanation is given right here in the curriculum. The chief problem with minimum variance optimization is that small changes in input assumptions can lead to large changes in the minimum variance and hence the efficient frontier. This problem is called instability in the minimum variance frontier. So the point is rather straightforward. You can go through an immensely elaborate exercise to come up with your minimum variance frontier. You have risk on the x-axis, expected return on the y-axis, but then you make a minor adjustment to your assumption about the correlation between assets. What will happen to this frontier? It will change. So instead of having this, you might have something like that. So that completely messes you up. Okay, so the whole point is that while you can do a lot of work in coming up with your efficient frontier, it is very sensitive to the input assumptions that you make. Okay. The problem of instability is practically important because the inputs to the mean variance optimization are often based on sample statistics, which are subject to random variation. Relatedly, the minimum variance frontier is not stable over time. Besides, the estimation error in means and variances and covariances shift in the distribution of asset returns between sample time periods can give rise to this time instability of the minimum variance frontier. So the whole point is that your variances might change over time. So depending, when you are taking data for the last 2 years and you get certain variance out of that, then over the next 2 years the variance numbers can change. Or if you take 4 years worth of data, then your variance numbers might be different from if you take 2 years worth of data. So in this section, all we are doing is coming up with potential issues that we need to be aware of. Fortunately for us, we are not going into the details of how to solve these problems. It's just that we need to be aware that all this fancy stuff that we are doing is an approximation and has issues. Okay, so what's a quick summary of this entire section? Theoretical, so you just need to know these points. I don't think you need to read the curriculum, or even I don't think it's worth reading Schwezer on this, but what is worth reading is the 6 bullet points or 7 bullet points in the summary of the curriculum, which is effectively what I have reproduced here. So what are the 2 categories of issues? The first category was coming up with your estimates. And what was the second category? The instability of the frontier. In coming up with the estimates, what were the 3 ways that could be used? One was historical, and what were the 2 issues here? It was the number of inputs. So it's the number of inputs, and what was the second item? Yeah, so the estimates might change over time. Okay, let's just quickly go back and refresh ourselves. Historical estimates are actually subject to estimation error. Okay, we don't need to know the exact details of all this. So there is estimation error. Okay, then what was the next one? Next we talked about using the market model, and there were certain formulas that you need to know. And the third one was, so market model used historical beta. Then the third was, rather than using historical beta, you use adjusted beta. And then what's the instability issue? All this says is that the minimum variance frontier, and hence the efficient frontier, is very sensitive to the inputs that we use. Okay. The second part of this reading is multi-factor models. And here again, you've seen this before. Where have you seen this? In equity, you've seen most of this. What's your classic single-factor model? CAPM is your classic single-factor model. What's the factor in CAPM? It is the market risk premium. Okay. In multi-factor models, you say that there are other factors in addition to the market risk premium that define the expected return on a asset. So that should sound familiar. Factors represent priced risk for which investors require additional return. So what's the factor in CAPM? We just said that's the return on market minus the risk-free rate, the market risk premium. Now in multi-factor models, we are going to look at three, and this again should be a refresher: macroeconomic factor models, fundamental factor models, and statistical factor models. In this reading, the focus is on macroeconomic factor models, which you have seen before. Fundamental factor models are briefly mentioned, but you saw these in detail earlier. We'll just read a couple of paragraphs from the summary on this. Okay, so the first category of multi-factor models, macroeconomic factor models. In macroeconomic factor models, the factors are surprises in macroeconomic variables that significantly explain equity returns. These factors can be understood as affecting either the expected future cash flows of companies or the interest rate used to discount these cash flows back to the present. Okay, so all we are saying is that we try to explain returns based on what? Surprises in macroeconomic variables. What do you think are the most significant macroeconomic variables that we use to explain stock returns? Things like inflation, GDP growth rate are the big ones. There might be others too, but these are the two big ones. And I think the best way to understand this is by looking at the example in the curriculum. Suppose that stock returns are affected by two common factors: surprises in inflation and surprises in GDP growth. So is this clearly a macroeconomic factor model? It is, because we are explaining returns based on macroeconomic factors. A portfolio manager is analyzing the return on a portfolio of two stocks, Manumatic and Nextech. The following equations describe the returns for these stocks whose factors, so these are the two factors, one is based on, what do you think this means? F, inflation. This is the surprise in inflation, and this is the surprise in GDP. So if this is the equation for Manumatic, what is the expected value of the return? 0.09. Very good. Why?
Because you don't expect any surprise.
Exactly. So since these are the unexpected surprises, what's the expected value? Expected values are 0, 0. What's the expected value of the error term? 0. So the expected value of the return here is this. Expected value of the return here is 0.19, and then anything else comes based on surprises. Okay. The sensitivity to a given factor. The sensitivities are sort of the betas to a given factor. So which stock is most sensitive to surprises in GDP growth? So clearly this stock depends a whole lot more on surprises in GDP. So this seems to be the more risky stock. Okay, now given those, this is the same problem, given those formulas, in evaluating the equations for surprises in inflation and GDP, amounts stated in percent need to be converted to decimal form. That's just a technique for doing this. So given the numbers that they use, we need to use decimals and not percentages. 1/3 of the portfolio is invested in M and 2/3 is invested in Nextech. What is the expected return of the portfolio? How will you do this? So it's 1/3 in M, so it would be 1/3 into 0.09 plus 2/3 into 0.12, and that gives you whatever it gives you. Okay, so that's straightforward, nothing complicated. Calculate the return on the portfolio given that the surprises in inflation and GDP growth are 1% and 0% respectively, assuming that the error terms are both equal to 0.5. Okay, now in the interest of time, I won't run through this here, but it's easy to do. What will you do? You will simply plug in GDP growth of 1%. So you plug in the growth. Okay, will you plug in the decimal or the percent? You will plug in the decimal, you will plug in the expected value for the error term, and then you will get your returns for the two. You will use their relative weightage, and you should get your answer. And just to make life easier, what I'll do is just give you the answers. What you should get here is so for one you should get 11%, and for this you should get 12.5%. So not difficult, just do the calculation, and this is example 10 in case you need to see the working. Okay, so remember there were three models that we talked about. What was the first that we just talked about? Macroeconomic. The other two are fundamental factor and statistical factor models. And just this should look familiar. In fundamental factor models, the factors are attributes of stocks or companies that are important in explaining cross-sectional differences in stock prices. Among the fundamental factors that have been used are the book value to price ratio, market capitalization, and PE ratio, and financial leverage. Looks familiar? Okay, so this is some of the multi-factor models that we talked about in equity. We don't have to spend much time on this here. In statistical factor models, statistical methods are applied to a set of historical returns to determine portfolios that explain historical returns. Now, to be very honest, the curriculum gives 2-3 more lines after this, which makes life even more complicated and leaves more unanswered questions. So I would say just learn this part, that in statistical factor models you use statistical methods are applied to a set of historical returns to determine portfolios that explain historical returns. Nothing given in the curriculum that explains this, so I don't think you need to know it in detail. Okay. Now, you also need to learn the arbitrage pricing theory. Arbitrage pricing theory is an alternative to CAPM, and it makes less strong assumptions relative to CAPM. You need to know the three assumptions, which are straightforward, that a factor model describes asset returns. There are many assets, so investors can form well-diversified portfolios that eliminate asset-specific risk. No arbitrage opportunities exist among well-diversified portfolios. So learn these three. The equation is familiar. So your expected return on a portfolio depends on the risk-free rate, and then it depends on these lambdas, which are the risk premium for factors, and then the betas, which are sensitivities. So the structure is similar to any factor model that you have seen before. The sorts, actually, this is a footnote from the curriculum that I just thought was interesting. An interesting issue is the relationship between what's APT, arbitrage pricing theory, and CAPM. If the market is the factor in a single factor model, then APT is consistent with CAPM. So do you remember the APT equation? It's simply if you just take one factor. So then you have, doesn't this look a whole lot like CAPM? So your expected return, that's the risk-free rate. The lambda is the market risk premium, and that's your beta. So that's all this is saying. The CAPM can also be consistent with multi-factors in an APT model if the risk premiums in APT model satisfy certain restrictions. These CAPM-related restrictions have been repeatedly rejected in statistical tests. Okay, now this is what you are likely to see on your exam. So examples 11 and 12, make sure you understand them. They are fairly straightforward. Suppose we have three well-diversified portfolios that are each sensitive to the same single factor. Okay, table 11 shows the expected returns and factor sensitivities. Okay, assume that the expected returns reflect a 1-year investment horizon. Using the data for portfolio A, so we are given the betas or the sensitivities. So using A and B, determine the risk-free rate and the risk premium for the single factor. So if just imagine, let's say that single factor is the market risk premium. Can you figure out that risk premium? And can you figure out the risk-free rate implied by this? Give it a shot. And all this is fancy terminology, but imagine that you are just creating a CAPM-like equation. What would you have? Yeah, so you just actually create this. For portfolio A, the expected return is 0.075. That's equal to what? The risk-free rate plus the beta, which is, or the sensitivity, 0.5 into what? Into the risk-free rate or into the this is the risk premium. Let's just use APT terminology and call that lambda. Okay, and then what's the second formula? 0.150 is what? RF plus 2 times lambda. Okay, so you learned this in class 9. 2 equations, 2 unknowns, you can solve. Okay, and I won't make you do this here. I'll just give you the answer. When you create these 2 equations and solve, what you get is lambda is equal to 0.05 and the risk-free rate is also actually 0.05. Alright, so fairly simple. A lot of the stuff is complicated sounding terminology, but the work that you need to do is not too bad. Given these numbers, can you estimate the expected return of portfolio C? You can use this sensitivity, this factor, and this risk-free rate to come up with the estimated expected return. It's given, but you can also come up with the expected return using the formula. And I'm sure you are used to this by now. The CFA Institute loves questions around arbitrage. So let's do example 12. You are given the following. So we are building on example 11. So this and this represent this represents expected return for A and the factor sensitivity, expected return for B and factor sensitivity, okay, and this is C. Then we are told that portfolio D is created by putting together 50% of A and 50% of C. So if you can create D by combining A and C, what is happening? You are also told that in the market, the expected return of D is 8%. So if in the market the expected return of A is 8%, but D can be created by combining A and C. Now notice what happens. So in the market, expected return of D is 8% and the factor sensitivity, the beta essentially, is 0.45. Okay. By combining A and C, so if you combine A and C, what is 50-50? The factor sensitivity is simply the average of the two. That's 0.45. So if you create D by combining A and C, the factor sensitivity is the same as what you have in the market. But by combining A and C, the expected return is lower than what you have in the market. So how do you make money out of this? What's the basic rule of arbitrage? What's the first phrase that comes to mind? Yeah, you buy low, sell high. Now, 0.08, is this high or low? Is this overpriced or underpriced? It is, remember, high return means it's underpriced. So in the market, since it's underpriced, what will you do with D? You will buy. Okay, you will buy D because it is underpriced. So that's the buy low, that's the D in the market. And what will you sell or short? You will sell A and C. Now if you do that, when you buy D, what's your cash outflow? So you are buying D, and then at the end of the period, if you get your 8%, you get from 10,000 you go to 10,800. And if you invest in A and C, that's so you shorted, actually A and C you shorted, so you got the money. And then what's the payoff later? Based on 7.25%. So at the end of the period, that's how much you want to pay. Your factor sensitivity, since you shorted, it's minus. The factor sensitivities cancel each other out, and you made 75. And then the curriculum says if portfolio D actually had an expected return of 8%, investors would bid up its price until the expected return fell and the arbitrage opportunity vanished. Thus arbitrage restores equilibrium relationships among expected returns. Okay, just nothing too difficult over here. Just go through the mechanics of this and make sure you can do your arbitrage transaction. In case you haven't figured it out yet, in almost every, starting from economics, this is a common theme. In fact, if I were to identify the two most prevalent concepts in level 2, one concept is arbitrage, and the other is this continuous multi-currency situations. So make sure you are on top of that. We are nearly at the end of this segment. In 4.5, the curriculum goes back and makes a quick comment on multi-factor models in practice today. We've already talked about macroeconomic factor models. All the curriculum says here is that something that you might recall from equity. We had a BIRR model named after the people who came up with this model. So this is a macroeconomic model, and that model, which happens to be famous because smart people came up with it, is based on 5 macroeconomic variables: confidence risk, time horizon risk, etc., etc. Okay, I just read this a couple of times. And then another comment on multi-factor models. In contrast, and this is important because it draws a distinction between macroeconomic models and fundamental models. In contrast to macroeconomic factor models, in fundamental models, the factors are stated as returns rather than surprises. In fundamental factor models, we generally specify the factor sensitivities first and then estimate the factor returns through regression. In contrast to macroeconomic factor models, in which we first develop the factor series and then estimate the factor sensitivities through regression. The factors of most fundamental factor models may be classified as company fundamental factors, company share related factors, or macroeconomic factors. Okay, nothing too complicated here. If I were to identify the one core point in this long paragraph, it's that macroeconomic factor models are based on surprises and fundamental models are based on stock specific or company specific factors. Okay, so that's it for this segment. In the next segment, we will wrap up this reading and continue the next reading.